Good evening, everyone. My name is Daniel Kotz. I'd like to talk to you all tonight about absorption accounting. And we'll talk about some dangers of absorption accounting if it's misused. I've created a short PowerPoint presentation to go along with this. You all should have a copy of that PowerPoint presentation as handouts. There's room for note taking on each page of that handout, so you can take notes or draw pictures or whatever you like. Anyway, let's get into it. What is absorption accounting? Absorption accounting is the process of taking fixed manufacturing overhead costs and adding them to the cost of goods manufactured. Essentially, it's like you're essentially taking those costs, and when you add them to the cost of goods manufactured, you've taken them from the income statement, put them on the balance sheet. Is that permissible? Can we do that? We'll get into that. Let me give you an example. A really good example of this is the American automotive industry. For years, the big three, Ford, GM, Dodge, operated with huge, massive fixed costs. They had factories, machines, employees they could not lay off because of contract terms, could not lay off in times of slow business. So they have these massive fixed costs, and to absorb those costs, what they did is they produced more and more vehicles. And then they used the absorption accounting to show that the cost per vehicle was low. They have these huge, massive fixed costs. They spread them out over millions and millions of vehicles, and that way they show the cost per vehicle is low. You're spreading that cost widely. Is it permissible? Well, under FAS 151, absorption accounting is permissible for normal capacity. Abnormal excess capacity, those costs are supposed to be treated as process costs. But there's no definition of what abnormal excess capacity is. So companies simply overproduce and end up to lower per unit cost. In the auto manufacturing industry, this overproduction inflated earnings by keeping those costs off the income statement, led to a huge inflated the balance sheet assets on the balance sheet, because now these costs are being shown as assets, and essentially ended up with a huge overproduction of vehicles. They kept churning out more and more vehicles to get up those fixed costs. Well, in my PowerPoint presentation, I've included a slide with a picture of what this did. The picture is basically a graveyard for unsold vehicles. There's brand new vehicles, unsold. Kind of where they went to die. That's what the caption of the picture was, where unsold vehicles go to die. So how do we combat this? Well, a primary way we can combat this is to change the way we structure executive bonuses. For years, executive bonuses are based on short-term pressure on managers, execs to produce in short term. Have earnings be high, paint a rosy picture of the industry or the business, and keep the shareholders happy. Well, with the auto industry, we saw that the picture they were painting was not really the accurate picture. There were major problems. This wasn't the only reason, but it was a major contributing factor. Companies can help combat this, but if they will restructure executive bonuses to basically get execs to focus on the long game rather than the short term. And as managerial accountants, our job is to focus on the best way to provide information that's going to lead to strategic economic decisions over the long term. So I hope that explained everything for you, and if you have any questions, now's the time. Thanks.